36 hours to Silvergeddon. China export ban meets. 26x delivery surge. Right now, at this very moment, silver is trading at 3 different prices simultaneously. $84 in Shanghai, $79 in Dubai, $72 in New York. A 17% gap. In a functioning market, this is impossible. Arbitrage traders should be closing this spread in seconds, but they're not. The gap isn't shrinking, it's widening. Why? Because in 36 hours, the world's largest silver exporter goes dark, and the delivery notices flooding into COMEX right now are 26 times higher than normal. Something catastrophic is unfolding, and most people are watching the wrong price. Welcome to Currency Archives. If you've been following markets for decades, if you remember when a handshake meant something and a man's word was his bond, then you know that what we're witnessing today is not normal market behavior. This channel exists for those who still value serious economic analysis over entertainment. We would be honored if you would subscribe, the way one might accept a trusted colleague's business card, with intention and respect for the information being shared. And please, let us know in the comments below. From which corner of the world are you watching this unfold? Are you in North America, Europe, Asia, the Middle East? Because what happens in the next 36 hours will reach every market, in every time zone. Now, let's begin. December 31st, 2024, the final trading day of the year. Most investors are preparing for New Year celebrations. Most traders have already closed their positions. Most analysts have published their year-end reports and logged off. But in the silver market, something unprecedented is happening. At exactly 3:47 p.m. Eastern Time, a senior commodities analyst at a major New York investment bank refreshes his trading terminal. He blinks. He refreshes again. The numbers don't change. Silver spot price in New York, $72, started 15 per ounce. He switches to the Shanghai Futures Exchange feed. Silver closing price, $84.55 per ounce. He calculates the difference, $12.40, a 17.2% premium. He picks up his phone and calls his counterpart in London. Are you seeing this? The response comes immediately. I've been staring at it for 2 hours. It's not a data error. This is the moment the global silver market fractures into 3 distinct realities. Reality number 1 belongs to China. In Shanghai, the panic is quiet but absolute. Manufacturing companies that require silver for electronics production are placing emergency orders. Solar panel manufacturers are scrambling to secure inventory. Industrial consumers who normally maintain 30-day supply buffers are now trying to stockpile 90 days, 120 days, 6 months if possible. Why? Because in exactly 36 hours, on January 2nd, 2025, China's export ban on silver becomes active law. This is not a proposal. This is not under discussion. This is a hard regulatory deadline, approved by the State Council, published in official government documents, and backed by export licensing enforcement mechanisms. After January the 2nd, no silver leaves China without explicit government permission. The Shanghai Futures Exchange reflects this reality. Buyers are paying $84.55 per ounce, not because they want to, but because they must. This is the price of certainty. This is the price of securing physical metal before the doors lock. Reality number 2 exists in the physical markets of the Middle East. In Dubai's gold and silver souks, where physical precious metals have traded for centuries, dealers are reporting transaction prices averaging $79.61 per ounce. This is not panic pricing like Shanghai. This is honest physical market pricing. Buyers in the UAE, in Saudi Arabia, in Kuwait, are not subject to the Chinese export ban, but they recognize something fundamental. Physical silver is becoming scarce. They see the China ban coming. They see the delivery pressure building at COMEX. They see inventories tightening globally. So they pay a premium, not out of desperation, but out of strategic awareness. The Middle Eastern physical price sits exactly between the panic of Shanghai and the illusion of New York. It represents the true global physical clearing price for silver in a world where supply chains are fragmenting. Reality number 3 is the ghost price, the COMEX spot price in New York, $72.15. This is the price displayed on banking apps. This is the price quoted on financial news terminals. This is the price most people believe is the price of silver. But here is the critical question. Whose reality is correct? A commodity analyst in Singapore runs a simple thought experiment. If silver is truly worth $72 in New York and truly worth $84 in Shanghai, then a risk-free profit exists. Buy 10,000 ounces in New York at $72, spend $720,000. Sell those same 10,000 ounces in Shanghai at $84, receive $840,000. Net profit, $120,000 on a single transaction with zero market risk. This is called arbitrage. and in functioning markets, it is impossible for such opportunities to exist for more than seconds. Banks, hedge funds, trading firms have entire departments dedicated to capturing these tiny inefficiencies. They should be buying every available ounce in New York right now. They should be flooding the Shanghai market with supply. The price gap should collapse within minutes, but it isn't happening. The gap isn't narrowing, it's widening. From $5 yesterday to $12.40 today. Why aren't the arbitrage traders closing this gap? Because they have done the math on something more important than profit. They have calculated the timeline. They have measured the distance between New York and Shanghai. They have factored in customs clearance, export documentation, physical shipping time, and they have concluded something terrifying. It is now physically impossible to move silver from New York to Shanghai before January 2nd. The arbitrage is dead, not because the profit isn't real, but because the metal cannot be delivered before the ban activates. The market is no longer pricing silver as a global commodity. It is pricing silver as 3 separate regional assets, disconnected by regulatory walls, divided by time zones, and fragmented by a 36-hour countdown that no amount of capital can stop. This is not a market correction. This is a market fracture, and the damage has only just begun. January delivery notices are supposed to be routine. Every month, futures contracts expire, and a small percentage of traders stand for physical delivery instead of rolling their positions forward or settling in cash. It's predictable. It's boring. It's a footnote in monthly exchange reports that almost nobody reads until December 30th, 2024. A compliance officer at the Chicago Mercantile Exchange arrives at his desk at 6:15 a.m. He opens the overnight delivery notice summary for January silver contracts. His coffee cup stops halfway to his mouth. He sets it down carefully. He opens the historical comparison spreadsheet, the one that tracks delivery requests over the past decade. Normal January delivery notices average 1-200 contracts. Each contract represents 5,000 ounces of silver. So a typical January sees roughly 6 million ounces standing for delivery. The screen in front of him shows a different number, 30,200 contracts. He recalculates 156 million ounces, 26 times the historical average. He scrolls through the data again, searching for a system error, a duplicate entry, a misplaced decimal point. The numbers don't change. This is real. Somewhere in Lower Manhattan. A silver trading desk receives an urgent call from their risk management department. We need to talk about your January position. The head trader already knows what's coming. How many delivery notices did we get? 47 contracts, all requesting physical settlement. There's a long silence. 47 contracts means 235,000 ounces. The trader opens his inventory management system. His firm has exactly 89,000 ounces in allocated storage. He needs to source an additional 146,000 ounces in 3 days during a holiday week, while Shanghai prices are $12 higher than New York, and the China export ban activates in 36 hours. Start calling the suppliers, he says quietly. All of them. This is happening simultaneously at trading desks across New York, London, Zurich, entities that normally trade silver as a paper asset, using futures contracts for price exposure without ever touching physical metal, are suddenly demanding actual bars. Why? The explanation requires understanding what has been building beneath the surface for months. Since August 2024, when China first announced rare earth export restrictions, institutional players have been quietly repositioning. The gallium ban came first, then germanium, then antimony. Each time, the pattern was identical. China announces restrictions. Prices spike. Supply chains scramble. Smart money began asking a simple question. What else might China restrict? Silver appeared on every list. China controls 20% of global silver mine production. China processes 35% of refined silver globally. Chinese industrial demand consumes nearly half of annual supply. If China ever decided to restrict silver exports, the impact would be immediate and severe. So a small group of industrial consumers and institutional buyers began a quiet accumulation strategy. They didn't buy physical bars. They bought COMEX futures contracts, with the explicit intention of standing for delivery when the time came. The strategy stayed invisible, because futures positions don't require immediate physical settlement. But now, with the export ban 36 hours away, the strategy is executing. And the delivery notices flooding into COMEX represent something far more significant than speculative trading. They represent a crisis of confidence in paper settlement. A supply chain manager for a major electronics manufacturer sits in a conference room in Seoul. His company uses silver in virtually every product they manufacture. Smartphones, tablets, automotive components. Their normal procurement strategy relies on just-in-time delivery from Chinese suppliers. But just-in-time assumes that supply chains remain open. 2 weeks ago, He received authorization to secure 6 months of silver inventory in advance. His team purchased COMEX futures contracts. And yesterday, they filed delivery notices for physical settlement. They are not speculators. They are not investors. They are manufacturers who recognize that the rules of global trade are changing, and they have decided that physical metal in a warehouse, even at a premium price, is worth more than a paper promise that might not be fulfilled. Back at the Chicago Mercantile Exchange, the compliance officer has finished his morning briefing with senior management. The question on everyone's mind is simple but terrifying. Can the exchange actually fulfill these deliveries? COMEX registered silver inventories currently stand at 278 million ounces. The January delivery requests total 156 million ounces. Mathematically, there's enough silver. But mathematics assumes that every registered bar is available, that every warehouse is operational, that every logistics provider can execute during a holiday week. It also assumes that no additional delivery notices arrive for February, March, or April contracts. The exchange has never faced a stress test of this magnitude. In 2011, during the silver price spike to $49 per ounce, January delivery notices peaked at 4,800 contracts. In 2020, during pandemic supply chain chaos, notices reached 6,200 contracts. The current number is 31,200. This is not a spike. This is a paradigm shift. A senior analyst at a London bullion bank publishes an internal memo that afternoon. The title reads, COMEX Delivery Crisis, When Paper Markets Meet Physical Reality. The conclusion is blunt. The 26x delivery surge represents institutional recognition that counterparty risk now exceeds price risk. Clients are choosing physical possession over contract exposure. This is not speculation. This is survival instinct. The memo circulates quietly among trading desks. Nobody disputes the analysis, because everyone in the physical metals market recognizes what is happening. The China export ban is not just restricting supply. It is revealing how fragile the entire global silver market has become. And the delivery notices pouring into COMEX right now are not just requests for metal. They are votes of no confidence in the system itself. There's a fundamental law in financial markets. It is not written in any textbook. It is not taught in business schools. But every professional trader learns it within their first month on a trading floor. The law states easy money doesn't exist. If a risk-free profit appears, it vanishes in seconds. Algorithms detect it. High-frequency traders capture it. Arbitrage desks eliminate it. The market self-corrects, always, without exception. Until December 31st, 2024, a quantitative analyst at a proprietary trading firm in Connecticut runs his standard morning arbitrage scan. His algorithms monitor price differentials across 47 global exchanges, searching for inefficiencies, for gaps, for opportunities. The system flags silver immediately. Shanghai, $84.55, New York, $72.15. Differential, 1240, percentage spread, 17.2%. The algorithm calculates potential profit on a 100,000 ounce transaction, 1,024 million. It recommends immediate execution. The analyst stares at the screen. Then he does something his algorithm cannot do. He opens a calendar. Today is December 31st. The China export ban activates January 2nd. That gives him 36 hours. He opens a logistics calculator. Securing 100,000 ounces of physical silver in New York, 4-6 hours. Arranging export documentation, 8 to 12 hours. Customs clearance in the United States, 24-48 hours. Air freight from New York to Shanghai, 18-22 hours. Customs clearance in China, 24-72 hours. Import licensing and delivery to buyer, 12,024 hours. Total timeline under optimal conditions, 164 hours. He has 36 hours. The math is impossible. He marks the opportunity as non-executable and moves to the next scan. The same calculation is happening simultaneously at trading desks in London, Singapore, Hong Kong, Zurich. Every arbitrage trader sees the $12.40 gap. Every algorithm flags it as a massive opportunity. And every human trader who understands physical logistics marks it as impossible. But the gap is not closing. In a functioning market, the mere existence of such a spread would trigger anticipatory trading. Smart money would buy in New York, expecting the price to rise toward Shanghai levels. Other traders would sell in Shanghai, expecting the price to fall toward New York levels. The gap would narrow, even if physical delivery couldn't be completed. But that's not happening either, because the markets are no longer connected. A veteran commodities trader in Singapore, a man who has spent 34 years in precious metals, sits in his office overlooking Marina Bay. He has seen every kind of market crisis. The 1997 Asian financial collapse, the 2008 global banking failure, the 2020 pandemic supply shock. But he has never seen this. Markets are supposed to be efficient, he explains to a younger colleague. That's the entire foundation of modern finance. Information travels instantly, capital flows freely, prices converge. He gestures at his screen, showing the Shanghai-New York spread. This is proof that efficiency is an illusion. It only exists when the physical world cooperates, when borders stay open, when ships can sail, when planes can fly, when governments allow trade. He pauses. The moment a government says no, all the algorithms in the world become useless. All the capital in the world cannot move metal that is not allowed to move. The younger colleague asks the obvious question, so why isn't New York rising to meet Shanghai? The veteran leans back in his chair. Because New York traders don't believe Shanghai prices are real. They think it's panic. They think it's temporary. They think sanity will return after the holiday. Will it? Ask me on January 3rd. At a major bullion bank in London, a risk committee convenes an emergency meeting. The agenda has one item, silver arbitrage exposure. The head of commodities trading presents the situation. We currently hold 2.4 million ounces of physical silver in London vaults. Our models show we could theoretically sell this inventory into Shanghai at an $11 premium, generating approximately $26 million in risk-free profit. A risk officer interrupts, why haven't we? Because we cannot deliver it before January 2nd. And after January 2nd, we cannot deliver it at all without Chinese import licenses, which are not being issued for commercial silver. So the inventory is trapped. Not trapped, just disconnected. It exists in a different economic zone now. We can sell it in London, we can sell it in New York, we can sell it in Dubai, but we cannot sell it in Shanghai. Another risk officer asks the critical question, what happens to our Shanghai counterparties who are expecting delivery? There is a long silence. They will have to source domestically, at whatever price domestic Chinese suppliers demand. This is the hidden crisis within the crisis. Before the export ban, global silver markets operated as a single interconnected system. Buyers in Shanghai could source from Peru, from Mexico, from Australia, from Poland. Sellers in London could deliver to Tokyo, to Mumbai, to Seoul, to Shanghai. The market was liquid, flexible, efficient. But starting January the 2nd, that system fractures permanently. China becomes its own closed loop. Whatever silver exists inside China stays inside China. Whatever silver exists outside China cannot enter China. Two separate markets, two separate price discovery mechanisms, two separate supply-demand dynamics, and no arbitrage bridge connecting them. A derivatives strategist at a New York hedge fund writes an internal research note that evening. The title, When Arbitrage Dies, The End of Global Silver Pricing. The key excerpt reads, the current Shanghai-New York spread is not a temporary dislocation. It is the new normal. Markets are learning in real time that political borders can override economic efficiency. The assumption that capital can always flow to the highest return, the assumption that goods can always move to the highest bidder, these assumptions are now demonstrably false. We are witnessing the end of the global silver market and the birth of regional silver markets, each with its own price, its own supply, and its own rules. The note circulates among institutional clients. Nobody refutes it, because every professional in the commodity space recognizes the truth. Arbitrage requires three things: price differential, available inventory, and the ability to move that inventory. The China export ban eliminates the third requirement, and without the ability to move metal, price differentials become permanent. At exactly 11:47 p.m. on December 31st, a trader in Hong Kong sends a message to his team. Shanghai opens in 9 hours, New York opens in 14 hours. The spread is now 13.22 tremors. This is the last day these markets trade with any memory of being connected. After tomorrow, they are different assets entirely. He attaches a chart showing the widening gap over the past 72 hours. The trend line is unmistakable. Divergence, acceleration, separation. The global silver market is not correcting, it is dividing. And the final countdown has begun. January 1st, 2025. 12 a.m. The new year begins. Fireworks explode over Sydney Harbor, over Tokyo Bay, over Hong Kong's Victoria Peak. Millions celebrate. But in trading rooms across Asia, a different kind of countdown is underway. 24 hours remain. Not until the next holiday, not until the next earnings report. 24 hours until the global commodity infrastructure changes permanently. A strategic planning team at a German automotive manufacturer gathers in Stuttgart. They are not celebrating. Their company produces 4.2 million vehicles annually. Every single vehicle contains silver, electrical contacts, circuit boards, sensor arrays, battery management systems. Their current supply chain sources 18% of silver components from Chinese suppliers. The procurement director opens a presentation titled Post-Ban Supply Scenarios. Slide 1 shows 3 potential futures. Scenario Alpha, minimal disruption. China grants export licenses to existing commercial contracts. Supply continues at 85-90% of previous levels. Prices stabilize within 30 days. Probability 15%. Scenario beta, managed transition. China restricts exports but allows limited licensing for critical industries. Supply drops to 40, go to 60% of previous levels. Prices remain elevated but predictable. Alternative suppliers scale up over $12 in 18 months. Probability 45%. Scenario gamma, complete fracture. China halts all commercial silver exports indefinitely. Domestic prices inside China decouple permanently from global markets. International buyers face sustained shortage. New mining projects require 3 to over 5 years to reach production. Probability 40%. The room is silent. Someone finally asks, "What's our plan for gamma?" The procurement director closes his laptop. "We don't have one yet. That's why we're meeting today." This conversation is repeating in boardrooms across 3 continents, electronics manufacturers in South Korea, solar panel producers in California, medical device companies in Switzerland, photography equipment makers in Japan. Every industry that depends on silver is running the same analysis and reaching the same conclusion. The comfortable assumptions of the past decade no longer apply. A commodity research analyst in London publishes a report at 9 a.m. GMT. The title? Silver and the New Protectionism, Mapping Commodity Fragmentation. The executive summary reads, China's silver export ban is not an isolated event. It is the continuation of a strategic resource control policy that began with rare earths in 2010 and accelerated dramatically in 2024. Gallium exports restricted in July, germanium in August, antimony in September, silver in January. The pattern is clear. Beijing is systematically asserting sovereign control over materials critical to advanced manufacturing. The report includes a chart. It shows 17 different materials where China controls more than 30% of global supply. Rare earth elements, 70% control. Graphite, 65% control. Bismuth, 55% control. Antimony, 48% control. Tungsten, 42% control. Gallium, 94% control. Germanium, 60% control. Silver, 35% control when including refining capacity. The question the report poses is simple. Which material is next? A supply chain director at a major electronics firm in Taiwan reads the report. He immediately schedules an emergency procurement review. His company uses 14 of the 17 materials on that list. For years, his procurement strategy was built on a single principle: source from the cheapest supplier. That supplier was almost always Chinese. The strategy was efficient, it was cost-effective, it was profitable, it was also catastrophically vulnerable. He opens a risk assessment model. The model asks, if China restricted exports of all 17 materials simultaneously, how long could production continue? The answer appears on screen: 11 days. 11 days before assembly lines stop, 11 days before warehouses empty, 11 days before the company that employs 47,000 people begins mass layoffs. He picks up his phone and calls the CEO directly. We need to talk about geographic diversification, not next quarter, now. This realization is cascading through global supply chains. The silver ban is not just about silver, it is a proof of concept. It demonstrates that China can, at any moment, for any reason, cut off access to materials that the rest of the world depends on. And the rest of the world has no short-term countermeasure. A geopolitical analyst at a Washington think tank publishes an op-ed in the Financial Times. The headline, Economic Sovereignty and the Weaponization of Supply Chains. The core argument. For 3 decades, globalization operated on the assumption that economic interdependence would prevent conflict. If nations relied on each other for essential goods, they would have powerful incentives to cooperate. The theory was elegant. The theory was wrong. What we are witnessing is the strategic use of interdependence as leverage. Nations that control critical resources can now impose costs on rival economies without firing a single shot. The silver export ban is not trade policy, it is statecraft. The article goes viral among policy circles because it articulates what many have been thinking but few have been willing to say out loud. The rules have changed. At 3 p.m. on January 1st, a closed-door meeting takes place at the U.S. Department of Commerce. Representatives from the Defense Department and the Energy Department and the National Security Council attend. The topic, critical mineral vulnerabilities. A briefing document circulates. It lists 50 minerals classified as critical to national security. Silver is number 23 on the list. The briefing notes that U.S. domestic silver production has declined by 40% since 2005. It notes that U.S. silver refining capacity has declined by 55% in the same period. It notes that Chinese-owned or Chinese-controlled refining facilities now process 35% of global silver supply. A national security official asks the obvious question, if this escalates, can we produce our own silver domestically? The response from the U.S. Geological Survey representative is careful. We have the ore. We have dormant mines that could be reactivated. But bringing a closed silver mine back to full production takes 18 to 36 months minimum. Building new refining capacity takes longer. If you're asking whether we can replace Chinese supply in the next 6 months, the answer is no. The room absorbs this information. Someone finally says what everyone is thinking, so we're vulnerable. Correct. Meanwhile, inside China, a very different conversation is happening. State media publishes an editorial in the Global Times. The headline, "Silver export controls reflect China's right to manage national resources." The article argues that Western nations have exploited Chinese resources for decades at artificially low prices. It argues that China has every right to prioritize domestic industrial needs over foreign buyers. It argues that export controls are a legitimate tool of economic policy, used by the United States, the European Union, and other developed nations regularly. The tone is defiant. The message is clear. This policy will not be reversed. At 11 p.m. on January 1st, 3 hours before the ban activates, a silver trader in Shanghai sends a final message to his international clients. This is the last communication under the old system. After midnight, all inquiries regarding Chinese silver exports must be directed to the Ministry of Commerce Licensing Department. I have been told that licenses will be granted only for strategic government-to-government agreements. Commercial buyers should not expect approvals. It has been an honor working with you. I hope we meet again when circumstances change. He attaches a document. It is a list of every silver transaction his firm completed in 2024, 12,400 individual sales, 2,147 unique international buyers, 94 countries. All of it, ending in 3 hours. At 11:59 p.m. on January 1st, trading rooms across Asia fall silent. Screens display countdowns. 60 seconds, 45 seconds, 30 seconds. At exactly midnight, Beijing time, the China Customs Administration system updates. Silver is moved from unrestricted export to licensed export. The code changes from HS7106 to HS7106R. The R designation means restricted. It is a single letter in a customs database, but that single letter just redrew the map of global commodity markets. A veteran commodities analyst in Singapore, the same trader from Part 3, watches the clock turn to 12:01 a.m. His phone begins ringing immediately, clients wanting updates, clients wanting alternatives, clients wanting answers he doesn't have. He silences the phone. He opens a blank document, and he begins typing a memo to his firm's leadership. The first sentence reads, "The global silver market as we knew it no longer exists. What comes next will be determined not by supply and demand, but by geography, politics, and power. The era of borderless commodities has ended. We are now living in the age of strategic resource control, and the world is not prepared for what this means." He saves the document. He looks out his window at the Singapore skyline. The lights are still on, the city still functions, everything looks normal. But he knows that beneath the surface, something fundamental has shifted. The 36-hour countdown is over, the post-ban reality has begun, and no one knows how this story ends.